Hello and welcome to this edition of the video market update from Orbex.com. It was an interesting week, especially when the US jobs report were released on Friday, and as we warned before, also in our previous reports, the US dollar actually finally managed to post the biggest one-day gain of this year. The US jobs report came in much better than expected. The economy added more than 200,000 new jobs during the month of July, whether on the non-farm payroll or even for the private payroll, while the manufacturing increased for the third month in a row. The unemployment rate also ticked lower toward 4.3%, which is also the lowest level since the financial crisis, and the Fed is still calling it as a full employment. At the same time, the number of people in the labor force has increased, sending the participation rate slightly higher. The most important point about Friday's report was the wages growth. The month-over-month increased by 0.3% in line with the market estimates, but in addition to that, the year-over-year remained stable at 2.5%, despite the fact that estimates were also to slow down slightly toward 2.4%. Yet, this is still the lowest reading of this year. This was one of the easiest jobs report to predict, not in terms of the estimates, but when it comes to trading. Since the announcement of the data, the US dollar managed to rise across the board and continued to rise until the end of Friday's session, and continued also slightly on Monday. Last week we warned all of the traders around or who are following us at least and reading the reports not to rush and short the US dollar, at least from a technical point of view. The US dollar has been declining for the past 5 months, for 5 consecutive months, leading the technical indicators also to be heavily oversold on most of the time frames, whether on daily, monthly, weekly, and even also yearly. Moreover, the index has also reached the major long-term support, which stands between the 93 and the 91.80, which showed a clear support on Friday. We will talk, of course, about the levels later in this video, but however, this jobs report is still not enough for the Federal Reserve to go ahead and raise rates at least in September, as inflation remains very low and the Federal Reserve needs more data in order to assess. Moreover, most of the key economic activities remains also sluggish. Therefore, the US dollar rally is likely to be limited unless the economic figures comes in with a notable change or game changer over the coming weeks and over the coming months. As for the week ahead, it is likely also to be calm after a week of full economic releases and events last week. On Monday, it was, of course, as we all know, it was very calm with few economic releases across the board, whether in Asia, Europe, or also in the US. But tomorrow, on Tuesday, we have also during the Asian session, we'll be focusing on some inflation data from China, which is set to remain stable at 1.5, in addition to the US crude oil inventories, which will be released, of course, during the US session. On Thursday and during the Asian session, also eyes will be on the Reserve Bank of New Zealand, which also should be watched very carefully, especially after the recent rise in Kiwi, which so far it looks like the rise will not continue for a long time. But of course, we'll talk about it also later when we look at the charts. But in Europe, we will be watching also some manufacturing data in the UK, and also the PPI figures will be released also during the US session for the US. Finally, on Friday, we will be watching for the US inflation figures, which should give us some clues on whether if the Federal Reserve will be able to raise the rates or the Fed fund rate in September or not. This is it for the fundamental side of this video. But now let's take a look at some technical charts to update the levels that we will be watching over the coming days. Beginning with the US dollar index as always, and as we actually warned last week, we are finally probably made a bottom on last week, especially on Friday, especially after trading the whole week lower until the US jobs report was released, right from the same area that we talked about over the past few weeks, or actually 2 weeks ago. And in the previous video, we already we already talked about the same area between the 93 and the 91.80, which basically was the same area that held for the past also 2 years, since Q1 of 2015 or Q2 since 2015 until today. This area has been supporting the US dollar index on the longer term. Does it mean that we are starting to rise from here, like in the US dollar as a trend? I doubt it, but at the same time, we definitely need to see some sort of a retracement to the upside from the current level. So the weekly close last week is sort of like a reversal to the upside. At the beginning of the week, we saw a little bit of some sort of like unchanged all day across most of asset classes. Even in the US dollar index, we haven't seen any sort of rally, but we're still expecting some retracement to the upside in the next few days, in the next few weeks. But this is likely to be limited below even the 96. I believe that will be the maximum level to keep an eye on. At the same time, this technical outlook is supported by also technical indicators were heavily oversold, and crossed over to the upside. Even the RSI is still weak, but there is still a possibility for another spike higher, or another advance higher in the next few days. Going forward also to the rest of the currencies, and beginning with the Kiwi. The Kiwi, we are definitely right now back into the same zone after we can say actually that this was a fake breakout above the 200-week moving average and above even the area that we talked about over the past few months, since also almost a year. At the same time, right now we're back to retest. First of all, we're back below the 200-day. 200-week moving average. So the first also thing, or the second thing, is that we're back into the same area that we should keep an eye on, because right now it represents a solid support area. So right now we have the 73.99. It was broken earlier this morning, or especially on Monday, and also we have the 73.30 that we need to keep an eye on, which is like very 73.30. Which is very near from here, almost like 20 pips. Here I'm recording on Monday. I would suggest also to see some sort of recovery here, but a break below the 73.30. This would renew the negativity on the Kiwi, and possibly also, especially the technical, because are heavily overbought on most time frames. Well, even on the monthly chart is also overbought, but still a little bit strong. But at the same time, on the weekly chart, we need to see some sort of retracement at least toward the 73.30, and then we will decide from there where it might go. The Aussie has a little bit of a different story, but at the same time, we are still above the technical resistance area right now, which basically switched into support. But at the same time, we failed to break above the 200-week moving average for two consecutive weeks. Beginning of this week, we saw just a small decline, which is around less than 0.25%. I would still suggest that we see more downside ahead towards 78.40, just like at least for a retracement, especially the technical indicators also are heavily overbought and crossed over to the downside before any upside risk continues. So keep an eye on in the next few days to keep a track. The euro also, despite the decline on Friday, I mean, it was also another like limited downside. We've seen it like before, even for the past few months. But right now, within the trend, or within this positive trend, even though that the euro also made some advance on Monday, 0.2%, but there's still a possibility for another leg lower. Where I would still believe that there will be kind of it will be limited above the 115. 115.39 or even 115. I doubt it to see more than that decline before the uptrend continues. So we are still in a kind of like a retracement phase over the next few days and next few weeks. In addition to that, also we will be looking at the British pound. We broke the minor uptrend support on the or the trendline support on the daily chart after failure also to break above the 32.70s, 32.60s. First of all, this was because of the Bank of England decision, and we had only 2 members voting in favor to raise the rate, and 1 member also decided also to change his mind and to go back to support a rate hold. So for the time being, there's also a possibility for another leg lower in the British pound, possibly toward the previous highs of mid-May, which is around like 129.82. So far, the 130 is still holding. We were trying like to test the 130 earlier this day or earlier this week, but so far we failed to, or we actually succeeded in continuing trading above that. But 129.80s, that will be a level also to keep an eye on, because a breakthrough that support would open the way for another leg lower, possibly toward even 128.30.
to keep an eye on, which is also April highs. Dollar yen, there's nothing much to talk about dollar yen here because again we've been trading within a tight range over the past 5, and this is today the sixth session. At the same time, within the US dollar retracement, there is possibly some sort of a retracement to the upside, but I would suspect that such rally is likely to be limited below the 1160s, or even maximum I would give it like the 1270s, which represent the 50, I guess, if I'm not mistaken. Yeah, the 50 and 61.8%, the 61.8% for the Fibonacci from the recent decline. This is supported also by the technical indicators. We're still in a retracement phase. Gold and silver. Gold is still strong at the same time, despite the fact that we saw a notable decline on Friday, again due to a stronger dollar on Friday and the stronger US job support. But still, we're trading above the moving averages. That's number one. We're still above trading above the trend line, which might be even broken tomorrow. We never know. But I'll be looking for some sort of a retracement. Maximum retracement of will be around the 1230s, because it comes with a confluence between the 200-day moving average and the 61.8 from the recent rally. On the upside view, that would be a new trend line to keep an eye on, because that would be a huge and a good breakout all the way toward 1300. That would be a possibility, but we still need to look for further retracement. Silver, it continues also to actually silver tried to prove itself, but it couldn't actually continue that much. And at the same time, let me just move this all the way here, but because we still have the same area to keep an eye on over the next few days. So we failed to break above. We had a failure to break above the trend line. It was a fake breakout. At the same time, it continues all the way back down, and today it started the week lower, but at the same time, the good thing is that the support area is still solid around the 1615, which is also the lows of April, the lows of April 26th. So for the time being, I'll be still looking for a little bit of some sort of a retracement, but maximum retracement of 1560s before the upside continues. But I still believe that silver has still more potential, but we need to see it prove itself in the next few weeks. This is it for the week. Thank you for watching all of these videos for the past few months. Please also like, share, and subscribe to Orbex channels to get the latest video once they are announced or once they are published. If you have also any questions, comments, please leave them below this video on YouTube, and I'll try to get back to them as soon as possible. I'll see you once again next week. Have a good one.